In 2017, I read this book right here, and since then, my wife and I have made over $300,000 in investments in just a few years. So today I want to share with you what I consider to be the #1 investment book that I think everybody should read, which is Unshakeable by Tony Robbins. And don't worry, I'll have my editor put a cool cover on this so it actually looks nice. And I honestly believe that this is the best book to go from a complete beginner to a confident investor who knows how to pick the right investments, avoid fees, and then also have nerves of steel along the way because the stock market is going to drop. So today I want to share with you the top 4 lessons from Unshakeable by Tony Robbins. Now, before we get into it, take 2 seconds, hit like and subscribe. It really helps push this video out to more people. But let's go. Lesson number 1 is that you are never going to earn your way to financial freedom. So first of all, let's define what financial freedom is because I think it's a bit of a broad term. What I'm talking about today is specifically having enough interest coming in from your investments to cover all of your main bills like mortgage, groceries, car insurance, things like that. So let's say you need $50,000 per year to cover all of your main bills. If we divide that by 7%, which is the average return for the stock market after inflation, you're going to get about $720,000 roughly, which is not super conservative. So we could even go further and divide it by 4% and get 1.25 million as our financial freedom number in that scenario, which is not bad at all. And it's actually super achievable for people like us who just work regular 9-to-5 jobs. But the key is that you cannot just save all the money that you earn. You have to invest. So that begs the question, where should you put your money? Well, according to a study by Credit Suisse looking at the global investment returns for a really long time, since 1900, the #1 place to put your money is in the US stock market. After that, you can choose REITs, which is real estate investment trusts. And that's basically just a way to get access to the real estate market through the stock market. And then returns start to drop off because you're getting into things like bonds and commodities like gold, which historically are not known for building a ton of wealth. Okay, so we know that stocks specifically are the best long-term play. So which stocks should we buy? That brings us to lesson number 2, which is that index funds are your best friend. Now, if you don't know, index funds are basically a way to buy a big group of companies all with the single click of a button. And some really popular ones are ones like VOO or SPY. These ones track the top 500 companies in America. And these are companies you've heard of like Amazon, Home Depot, Walmart, all the really big ones that you know. Now, there is a debate on which type of index fund you should get. Should you buy mutual funds or ETFs? Some people like Dave Ramsey argue that mutual funds are the way to go. Others, like the ones in the FIRE movement, talk about how ETFs are better because they're lower fees. I tend to lean more towards the ETF side because they can basically do the same thing, but fees are going to absolutely kill you, and I'll talk about that in a second. But the point is that either one of those are better than picking individual stocks because even Ray Dalio, who's the greatest hedge fund manager to ever exist, basically, he says that you are not going to beat the market, and it's pretty much harder to do really well in the stock market, meaning outperform the market for a really long time. It's harder to do that than even win the Olympics because there are more competitors in the stock market and everybody thinks that they can win. So is it really worth spending your entire life pursuing something that you'll end up probably underperforming a very passive index fund that anybody can buy? Probably not. And again, Credit Suisse comes in clutch with another study showing that passive index funds have beaten every hedge fund strategy for the past 30 years by 2.8%, which is a ridiculous amount, by the way. So the point is that unless you're going to be a superstar investor and devote your entire life to this thing that you probably will not do super well at anyways, just buy some index funds and then spend your time doing something else. Now, I have a few individual stocks on my own, but it's a very small portion of my money so that even if they don't do well, it's not going to make any material difference in my life. So if you really want to pick stocks, you just have to buy a single stock because you think they're the best company in the world. Please do it with just a tiny bit of money that you're okay losing. All right, let's talk about lesson number 3 in this book, and that is that taxes and fees matter far more than you realize. So starting with fees, I'll use a very simple example to show you how ridiculous this is. So if you earn 7% with an investment and you compare that to one that earned 7%, but they took 2% in fees, like a mutual fund might, the difference across a long period of time is just gigantic. I cannot stress this point enough. Please understand the fees that you're paying when you're looking at buying some investments. And for this example, I chose 2% because it sounds like a really small number, but when we look at the actual end results, it's insane. So let's say that you invested $100,000 and you just let that sit for 50 years earning 7%, and we compared that to a fund that earned 7% but took 2 in fees. So you end up with 5%. The first fund, you're going to end up with $3.3 million, and the second fund, you're going to end up with 1.2 million. Now, 1.2 million is still great, but when you could have had 3.3 from just a simple switch and understanding the fees that you're reading on the prospectus, that one hurts. That's a really big mistake. And so if you don't know anything else about investments and you're looking at your index funds in your 401k or your IRA, look for something called an expense ratio. If the expense ratio is anything above, let's say 0.5%, it might be worth considering finding a different fund with lower fees. And again, some really low fee ones are ones like VOO, for example, or SPLG. So just keep that in mind. Now, as far as taxes go, the way that you can protect yourself from paying unnecessary taxes is using tax advantage accounts like a Roth IRA or a Roth 401k, for example. Now, these are going to be your best friend because Roth means that you're paying on money that you're getting now, and then your investment can grow tax-free over time. And so you're paying on a small amount, and then as it gets really, really big over the next 30, 40 years, you're going to have a couple million bucks completely tax-free. And this is my personal favorite way to go because I think that most of us are going to earn more money as we get older. And so I think it makes sense to pile up your investment accounts now while we earn a small amount, get taxed on that small amount, and then later we get to reap the benefits. Now, as a disclaimer, I'm not an accountant, I'm not a tax advisor, so take all of this with a huge grain of salt and talk to a professional if you're uncertain about this stuff and you don't want to do it by yourself. My goal is to simply give you a better understanding than you had before you watched this video. All right, lesson number 4, the final one on this list, is to never get out of the market. And I have 7 really good reasons why this is the case. So first is to understand that corrections happen once every year on average since 1900. Now, a correction, if you don't know, is technically when the market hits an all-time high and then it drops 10% from that all-time high. That's the definition of a correction. And this happens all the time. And this just happened a couple weeks ago and people are freaking out and everybody and their mom on YouTube is making market crash videos and you guys keep watching them. Stop watching those. There's no need to be afraid of this. This is completely normal. It's literally happened every year on average for the last 125 years. There's no need to freak out when the market drops 10%. In fact, just keep buying more because you're getting a 10% discount. Additionally, 1 out of 5 of those corrections turns into a bear market. So the definition of a bear market is very similar. The stock market hits an all-time high and it drops 20% instead of 10%. Now we're in a bear market. Now, whoever came up with these terms, I have no idea why. They seem to really scare people when they happen, but again, these things are completely normal. They have happened for 200 plus years. There's really no reason to get scared out of the market. Just know that they happen on a regular basis, and that information alone can give you some peace of mind knowing that this time is not different. It's not going all the way to zero. You are not going to lose everything. Which brings me to point number 3, and that's that nobody can predict this stuff, at least not consistently, and therefore they cannot be relied on. Now, Howard Marks talks about this in length in one of his famous memos back in 2022. It's called The Illusion of Knowledge, and he essentially says that forecasters cannot be right often enough to be worthwhile. In other words, don't waste your time listening to people who try to predict the market or to predict the economy, because it's really just the old story of the boy who cried wolf. Don't waste your time. Also, another reason to give you peace to stay in the market is that it rises up and to the right over time, even with minor drops. So one of my favorite things to do when things start to get a little bit scary and the market's dropping and everybody seems to be freaking out is to just zoom out. Perspective brings peace. Isn't that cute? They both start with P. No, but seriously, look at this chart. From 1870 all the way to now, every single gray line you see in this chart indicates a recession. That's a lot of them. They're normal. Nothing to be afraid of. Do not sell out of the market. Zoom out and get some perspective. After seeing those charts, I also wanted to ask ChatGPT what it thinks because why not? So from 1929 all the way to today, there have been quite a few bear markets. They used to be more frequent and longer lasting. Now they are less frequent and a little bit shorter generally. Also, according to JP Morgan, the stock market has never had a 20-year period of negative returns since 1950. And so if you bought at one point in time and you just waited 20 years, you would have at minimum 6% per year on average, which tells me that historically the best way to make money is to just zoom out and wait a little bit longer. So again, don't get out of the market. Another reason, bears become bulls. So markets typically soar right after a really strong dip. So check out this chart here. Every time there's been a bottoming out of the US stock market, the following 12 months have absolutely crushed from 17% to plus 69%. And this is why Howard Marks, one of the greatest investors to ever live, he's basically a second Warren Buffett, he says that selling at the bottom is a cardinal sin, and I could not agree more. But if you're still terrified and you're thinking about selling at the bottom of the market, check out the Fear and Greed Index. Just Google this and you can get a good sense of where the market is at right now and kind of how people are feeling. Now, this is important because Warren Buffett, the greatest investor of all time, says you need to be greedy when others are fearful and fearful when others are greedy. And so one small piece of kind of understanding where the market is at right now is to check this indicator, and it can at least give you a good starting point to understand where people's minds are at and, more importantly, their emotions. All right, the last point is that missing out of the stock market is the greatest danger to your investments. And this is something that I often talk about. I say inaction is riskier than action, meaning sitting on the sidelines and doing nothing is a guaranteed way to have a mediocre return and always be stuck at your job, having to earn your way to financial freedom, which we already know doesn't exist. The only real option that we have is to invest. And if you didn't know, the market jumps in bunches. And so the reason that it's dangerous to be out of the stock market at any given time is that we don't know when it's going to make its biggest jumps. And from historical data, we know that if you missed out on the top 10 days in the stock market over the past 20 years, your returns can go from 8% and get cut right in half to about 4%. If you miss the top 20 trading days, you'd be down at 2%. And if you miss the 30 best days over the course of 20 years, you would be at 0%. Think about that. That basically says that the market trends sideways for a really long time, and then every once in a while, it makes a big, meaningful jump. JP Morgan also found that 6 out of the 10 best trading days are often followed a couple weeks after some of the biggest drops. And so if the market dips and you get really scared and you sell out, you will most likely miss out on the best trading days, which again, affect most of your returns. And so I think a really cool way to illustrate why being in the market matters and timing it is a terrible strategy is if we take a scenario of 20 years and we pick 2 people against each other. Both people have $2,000 to invest every single year. The first person is the most perfect investor of all time. Every year they pick the dead bottom and they put that $2,000 into it. The second person is the worst investor of all time, and every year they pick the exact top, put all their money into it, and they never time the market correctly. First person is going to end up with 87 grand and the second person is going to end up with 72,000. Both are not too bad, especially when you compare them to the very end, which is sitting in cash. If you just saved your money, you'd have $50,000. So even the person who's buying at the top every single year still makes more than somebody who's scared and sits in the sidelines and just keeps their money in a savings account. So I know I just threw a bunch of stats at you and a bunch of different charts. Here's a quick recap. You can't earn your way to freedom. You must invest. Index funds are your best friend. Do not go all in on a single stock. Taxes and fees matter. Minimize both of these and never get out of the market. Time in the market beats timing the market. And if you made it this far to the end and you think I could really use some help turning my salary into financial freedom, I'm opening up a few slots to work one-on-one with you guys. So click the link in the description for that. Otherwise, check out this video next to see how I use some of these lessons in my own portfolio, and I will see you there. Peace.